Somebody's upset. Find out who starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Wednesday, April 21st, 2021, a day that will live in infamy. I remember it as though it was only yesterday, even though it was 2 weeks ago, because I think we're recording this on May the 5th, 2021. It was the day I got my vaccine, the AstraZeneca thing, not the good one, but that one. And so I didn't know how I was going to react, if I was going to die or not. Got the vaccine 10 o'clock in the morning. And then about noon, I get this email from BNN Bloomberg saying, hey, can you come on and talk about, I don't know, interest rates or debt or, stuff I don't really understand. But sure, happy to do it. It'd be cool watching me collapse on live TV. So I do the interview, went fine. I'll put a link to it in the show notes if you want to watch it. So then the next morning, they post the clip on their website, and they also put ads in front of the clip. So, okay, seems innocuous enough, right? Well, let me read you what somebody wrote on their blog. They put a picture, they put the clip of my thing. And I believe they said something like it was the greatest TV interview they had ever seen, although maybe I'm interpreting incorrectly. But here is what they wrote as well. I have to preface this clip, and again, on BNN Bloomberg, they run ads before the clip runs, okay? Because that's how they make money. So you got to watch two ads before you can see my smiling face. So there was an ad that ran before my clip. I have to preface this clip, this blog person wrote, it's by saying that the ad that leads in is one of the most sexist, predatory, revolting things I have ever seen. Gee, I wonder what she really thinks. Typical of sucking the retail trader platforms, but still a particularly heinous, I'm not sure if I'm pronouncing that right, heinous example of why the financial sales machine is so damaging. Encouraging people to try and win a down payment for a home with online trading is everything that is wrong in a nutshell. Ooh. Well, who said that? Well, of course, it was Danielle Park. Danielle, welcome back to the show. How are you doing today? Have you calmed down at all?
I'm calm. This is just the usual fodder that I see every day, all day, and I write and talk about it. And I also had the same AstraZeneca shot about the same time because we're the same age. And so maybe that was getting to me. Maybe it was impacting my brain function in some small way. I'm not sure, but I think it's because I think the paradox of all the financial media for me is that it is an opportunity when they do have someone with a few good thoughts to rub together and they do make some good points. It's an excellent teaching opportunity or source of perspective or information. But the bulk of what's on there is not that, right? The bulk of the guests that are there to sell the financial inflation aspirational model of how you get rich by picking stocks. And not only that, so when I do, bother to look through and see if there's any clips of souls that I think might be useful in terms of understanding and helping educate people, then they run these ads in advance of it. And the ads are all from the sponsors. And of course, the sponsors are the predatory, as I call them, because they're designed to specifically, attract people like an addiction, like a gambling thing. And they incent them with all the hot buttons. And those are the ads that you have to sit through just to get to the 5-minute clip of someone with a few words of wisdom. So that's why I saw what you were saying. And I'm like, yay, Doug, go Doug, you're good. You're one of the good guys with the right information. And then they preface you with this horrendous junk, which is so typical.
Well, so let's start with the backstory here then. So you were a guest back on episode number 248. We talked about building wealth in a changing world. And I believe we recorded that in May of 2019. So almost exactly 2 years ago. We actually got to do that in my Toronto office. So I'll put a link to that for people to see what we talked about a couple of years ago. For the people who didn't watch that, can you give us the quick overview of what it is you do, where you do it? Tell us that.
Sure. So I'm a lawyer. I'm a financial analyst. I work at a company called Danielle Park Investment Counsel, which I co-founded with my partner in 2003. And before that, I'd worked in a large securities firm for 6 years on the sell side. And now we're a fee-only asset manager We give comprehensive advice, financial planning, including asset management for households with $1 million or more.
So if I've managed to save up a bunch of money, I call you up and I say, hey, Danielle, I'm going to give you $1 million or $10 million or whatever I've got. And then your goal, I assume, will be to not lose the money, but make me a few bucks.
Yeah, it's foundational before that, though. That is where most people enter the equation of financial services is typically, what have you got? What are we going to throw it into? We look at it much more from the ground up in terms of, wait a minute, don't tell me about what savings pot you want to give me. First of all, tell me about you, your personal situation, your dependents, your liabilities, any debts, your income, your prospects of how long you expect to work, your health, like all of that. And sometimes we go through that process with people and the right advice to them is, no, you're not someone that should give anyone money right now. What you should do is these 4 things. And then very often, 2, 3, 4, 5 years later, those same people will come back and go, okay, I did all those things. And now what should I do? And so it's a much more long tail kind of process, typically what we do.
Now, I understand how the investment world works, because I got a podcast. So I'm clearly an expert on everything. And the way it works is I buy a mutual fund and there's this hidden 2% fee that goes to whoever sold it to me. So is that how you work?
No, nothing we do is hidden. We charge an annual fee on the assets that we manage. And that's the all-inclusive charge for our services.
So it's a percentage of however much I've put with you. So you actually want my investments to not go down, preferably go up, because I guess then next year I'll have more assets and you'll make more money. But with a stockbroker, the more I buy and sell, the more commission they make. That's not the way it is with you.
Well, it is true that there's a lot of financial services that are transactional that get paid to put your money into things. But there is also a lot of financial services today that are fee based. So even stockbrokers offer fee accounts. A lot of the models, though, are still this kind of vestige of the old days where if they have more of your money in equities, they get a larger percentage, even if it's a fee based, than if they have some of your money in bonds, for example. There's an inherent bias in a lot of the pricing models. And then a lot of the times as well, they're still the sales force for the institution behind them. So in other words, the large investment companies, they see the retail accounts as the distribution channel for the products which the company is underwriting. So even though your broker may be a nice person, may charge you a fee, may not charge you transactions based on commissions and all that, they still get sales calls from head office saying, hey, 70% of our income comes from the products we underwrite for the companies that we work for. Don't kid yourself. The client, the retail person, is not where our bread is primarily buttered. They are there to receive the products which we are selling for the companies that are trying to get it into, swap cash from the investors into their coffers and give you their securities.
Gotcha. Okay, so now let's talk about this commercial that you didn't like. And again, I'm not going to play it because they're not paying me to advertise here. If someone wants to pay me a lot of money to sell my soul, then great, give me a call. I'm on Twitter. I'm easy to find. But the commercial itself was something along the lines of, it's the end of the day. There's a female who is in bed, getting ready to go to bed. And I believe she's got her phone or something and she's looking at stuff. And I believe she is obviously pregnant. Looks like she's, 7 or 8 months along. And there is a guy, I'm guessing her husband, I don't know, but he's off in the bathroom brushing his teeth, obviously getting ready for bed as well. And she says, oh, I see that our friends Joe and Mary just bought a house. And he says, as he's brushing his teeth, oh, well, that seems pretty early because they're like us. And oh boy, I don't know how they managed to pull that off. Yeah, we're broke. How can they do it? And she said, oh, well, they use this broker that has lower fees. And as a result, they've been able to make all this money and they could buy a house. And he goes, oh, and that's kind of the end of the commercial. So what's the problem with that? Like, isn't everybody in that boat? What did you find, to use your word, sexist, predatory, revolting, and particularly heinous about that commercial?
Because it's pulling on all the emotional strings. It's, first of all, that's, I think, Quest Trader, one of them, but it doesn't matter. They all use the same theme. It's essentially, are you a dummy? Are you not with it? Are you not a good provider for your family? Are you not a real man? Which is what I took particular offense to in that case, that the woman, was the incubator of the baby. Great. That's what we do. But, putting the pressure on the partner to say, if you don't get going, like, we're never going to have a home for this child. And all that sexist stereotyping is what feeds into people's fear of missing out, people's compulsion, addiction, to get them gambling, to get them risk taking. I remember there was an ad series in 2007, which was really repulsive as well. And it was older people. And they were talking about how they were day trading now because you've got to be brave. I remember this whole nonsense. And I used to literally throw my socks at the television if it would come on in the morning, because it's just the opposite of the correct information. You should not be trying to manufacture a down payment for your home by stock trading or by taking high flying risk with whatever savings you do have to try and get yourself into a home. And if you're desperately trying to scrape together the down payment like that for a housing market that, for example, is 7 times the average household income, as you know, Doug, and that's just nationally today. That's not even in a large center like Toronto or Vancouver, where it's 10 or 11 or 12 times. I mean, these are the wrong financial decisions for people to try and lever yourself into financial bubbles in the hopes that you're going to just do basics like provide a home for your children. So I just think there's a whole bunch of stereotyping there. It is the right financial decision, as you well know, to sometimes not reach for overvalued house as the dream, because it can be hell's kitchen if you're stressed out financially, fragile. And that's what most Canadians are doing today. So it's not always the best thing, but it's promoted and it's, as I say, dramatized as if that's the smart financial decision. And that's because the advice is coming from the sales side, the product sales side, the credit sales side, the trading platforms. They are all trying to dupe in the little person, because it's essentially a Ponzi scheme, Doug. The whole thing's a Ponzi scheme, especially right now. And so they've got to get new blood coming in, because the asset managers of the world are already fully loaded. They've already got almost no cash on the books. Everybody that's in is in. So they have to keep trying to sucker in the next little guy and get them to keep the gig going.
Well, I guess Bernie Madoff is gone, so somebody else has to pick up the torch. So, okay, I totally get everything you're saying. So let me just make a quick distinction there. Rip Bernie Madoff. I know he passed recently, whatever, but that is a very extreme example. Clearly, he was running something that was pure Ponzi. What I'm describing here is a more almost damaging thing, because it is systemic. It is 90% or more, probably 95% of the services out there, of the advisors, of the advice that people desperately need financial advice. You're not born knowing what to do with money. If you don't have parents or family or someone near you that has actually got wisdom around it and can help you. I mean, the stories are epic. The athletes, the musicians, the people who win money in lotteries. And if you don't know how to look after it, maintain it, have discipline around it, you end up losing it, or you end up having really negative experiences. So what I'm saying is, yes, there's the Madoffs of the world who are pure Ponzi's, but there's also this whole structure in place right now, right from central banks through to the distribution channels of these product sales firms, which are trying to sucker people in, get their savings in so that they can keep prices going up, even when prices make zero financial sense or are not investment quality and not investment grade. They keep selling it as if it is the wise thing to do. And that's where I get very offended. A whole bunch of different ways we can go here. This would have been good if I'd had a script, because then I would have known what to ask you. But so let's talk about assets then. Why don't we start there then? So the way you are describing it, we are in something of a bubble. And I would say, well, yeah, duh. Like, look at house prices. You already said that the average house price across Canada is 7 times household income. But you're right. In Toronto, to buy a little tiny condo, it costs $1 million. And so unless I'm probably not making 100 grand. So I'm probably paying, 8, 9, 10, 11, 12, 15 times household income, which is really difficult to get into that kind of a market. What advice then would you give to somebody watching this? Because, you and I are of a certain age, we're both 35. And back when, I remember exactly when I bought my first place, it was 1989. And I was over levered and all the rest of it. It was a townhouse, cost $205,000. And at the time, I don't know, I was probably making, maybe 50 grand a year, 40 grand a year. I can't remember. So I paid, 4 times, 5 times my income, whatever. And I was able to buy it. And eventually I, married someone who had a brain and she straightened me out and everything was great from then. But today, how can I possibly get into the housing market? If I was, graduating and, you and I have kids that are of roughly the same age. My son just graduated from university. He's 22 years old. Well, there's no way he's buying a house. And most of his peers are graduating with a whack load of student loan debt. So they're going to spend the next 10 years paying off student loans. And then in their mid 30s, they can start saving for a down payment. So maybe by the time they're 50, they might be able to get into the housing market. What do you say to those people? Is there any advice you can give them? Any words of wisdom, or are they all?
Sure. Because the theme of secular trends is very important here. Yes, I also bought my first house in Ottawa in 1991. It was like a townhouse for $97,000. My partner and I, at the time, we were earning, I think together $50K. So it was 2 times 2 times income, and we were still tight because we had student loans, et cetera. So, but yes, that was a secular change. And why, in other words, since then, what we've seen is this enormous move up in price of housing as interest rates have fallen, right? So this whole thing has been largely contrived to a great degree by central banks, getting interest rates to go down, also by the fact that governments have been underwriting the mortgage market, as you well know, CMHC in Canada, supporting in this whole belief that it's best for people to get in on the property ladder. We've seen this in the US housing bust into 2006, the UK, where a lot of my relatives are from, same thing. Everyone believed that no matter what the price, it was best to get into the housing market. And of course, prices collapsed after both of those events, 50 to 60%. And it takes a decade or so for prices to typically recover. That's what happened in the 1980s, early 80s to 90s, housing flat, prices collapsed. That's why we were able to get in at a relatively low point. So it isn't always in everyone's best interest to jump into an asset regardless of price. And that's my best advice to people is it's always in your best interest to build up savings, to spend less than you make, to find cost-effective ways to live. And right now, if that means renting something, sharing rent with other people, moving out of urban areas to somewhere where you can live cheap. If it does mean living with your extended family for a period of time because you want to save money, because you're trying to get your nest egg. And I think that the bottom line is the world is full of people trying to take your nest egg who are incented by commissions to get your nest egg into various things. And the real estate market right now is just a frenzy of genius advisors, which are all collecting commissions on the front end. I'm not saying there's not good real estate agents who are trying to do the right thing, but we're talking about a frenzied mania right now where people are not having inspections and they don't want to, get anything pre-approved. And these blind bidding wars where your agent who's going to get more of a commission is recommending that you go in way over ask. The conflicts inherent in this are obscene. And this is the same conflicts that I've seen in the financial industry for years. And this is why I'm so aware when I see them. So yes, the right thing to do is the right thing for the individual. And sometimes that might mean, if you do have a nest egg, and sometimes people write me and they say, I've got $500,000 in savings. My spouse and I make a great, good, solid income. But we don't want to reach for this house that's $900,000 because we think. And my point is, you have to look at the facts all together. If you're going to be happier being in that house, if you're feeling more sustainable, you don't have to move, all that, and your finances make sense, well, yeah, maybe buy that house and maybe be prepared that 10 or 15 years from now, that house could be worth the same that it's worth today. And if you're okay with that, then it might be the right thing to do. But if your idea is, oh no, it better go up X or else, we're going to be in trouble. Or if it doesn't double in the next 5 years, my plan's not going to work. Then you're talking about gambling again. You're not talking about the wise financial decision. And that's where I like to try and draw a line and make people see that there's a difference between those two things.
Yeah, I'm a big believer in viewing a house as a consumer good, not as an investment. Yeah, it may go up in value, but you're right. If you look at the period from what we're talking about, 1990 to 1997, real estate prices were flat or down. And in fact, that property I purchased in 1989, I sold in 1997 for $20,000 less than I paid for it.
That's it.
Because that's actually happened.
That's a secular trend. And the probability of that being the case a decade from now is extremely high. So I just, caution people. The other thing is that this whole war on savings, because people are reaching for so much in shelter and paying their mortgage, which they see as almost like a perpetual plague they're going to have for the rest of their life. Many people don't even think they're going to ever pay off their mortgage. This is erroneous thinking. It's very self-destructive. And meanwhile, you're not going to be able to save in any meaningful way. Because one of the shocking things that I actually almost always advise is to pay off your mortgage before you start trying to invest for your retirement. And, people break out in laughter in places like Toronto because they think, well, that's ridiculous. I'll never get to save for my retirement. Well, this is the point. If your shelter cost is so obscene that you're never going to get out of debt, you're never going to really be able to maximize your savings. And so this is why you have to put the, cart and the horse in the right order.
Yeah. And obviously I'm a big believer in getting out of debt too. So I'm not going to disagree with you there. Okay.
One other little, I watched a show, one of your podcasts, and I won't say who, but there was someone who recommended that a person who had some extra cash should put it in something like cryptocurrency rather than potentially pay off their high credit card debt. And I threw my socks at the TV that time as well, or my screen, because I think that we have to be so careful. The other type of financial advice that is doled out daily is from billionaires, like a Warren Buffett style thing, or someone who's, betting a lot, who has possibly, now sometimes not, because sometimes they're very self-destructive in their financial choices too, but potentially someone who has their house paid for, has savings, has their kids educated, doesn't have any debt, and they're doing things in something high risk like a cryptocurrency. Fine, maybe in their scenario that makes sense. But to give general information of saying, if someone has going to pay off their credit card, or I would say maybe buy cryptocurrency, that's the kind of thing where they're not looking at it foundationally for the individual. And little people, so to speak, hear that, think, well, that person's wealthy. They must know. This rich guy on TV or this rich woman on TV said that you should do this with your savings. That's also extremely reckless and dangerous. So, you have to always try and not take these general platitudes about whether Warren Buffett's worried about the stock market valuations when his fund is fully invested most of the time. So he's never going to say, I want to be the hell out of this. He's never going to say that. And if an average person hears him say he's not worried, they think, well, then I shouldn't be worried about my life savings. Meanwhile, he's a billionaire at the end of his life, surely. He's in his 90s now. And you're 45 or 55 with potentially 40 more years to go here. There's a big difference.
Well, and obviously you're referring to last week's podcast, which had Jeff Booth on it. That was episode number 348. And yes, I've got a lot of comments on that comment that he made. And it was a little bit of a blindsided question that I asked him, because I said, okay, Jeff, give people financial advice. If you have credit cards, what would you do? And he said, well, my advice to everyone is put a little bit of money into cryptocurrency over a long period of time. So I think the example he used was, $100 a week. But you're right, that's a number that means nothing unless you know what the person's other income thing. I believe he also did say, I wouldn't be borrowing to do it. But of course, if you owe money on credit cards, then you actually are borrowing to do it. So I'm sure if I could get him back on and say, can you clarify that for me? He probably would say, well, yeah, I do agree that, debt is not a good thing. But you raised last week's show. So let's talk about the main topic. It was an interesting show because the comments I got from people were a lot of the little offhanded remarks he made rather than the central comment, the central theme, which was deflation.
Yeah.
And so this is something that I don't think anyone understands because you already went through a whole list, real estate prices way up, stock market way up. That sure sounds like inflation. So where do you stand on this issue? Should I be thinking about inflation or is deflation actually a possible thing?
Yeah, so I'm more in the deflationary camp, at least at this point, and we have to manage our portfolios. Like we have to actually make decisions about where to allocate capital. So I actually do have to form some thinking and thesis around that. We spend a lot of our energy on trying to figure that out. And basically, the main reason that I think deflationary pressures persist is that what we've had is asset inflation. Intentionally, right? Central banks want to basically keep asset inflation going up because they don't have a lot of control over any of the other kinds of inflation. For example, by constantly incenting more borrowing, they're actually digging the economy a bigger and bigger hole. Lower interest rates could have been used to help people get out of debt faster, in which case we would be sitting on excellent balance sheets, very low debt ratios, big piles of savings. And those are the tinder of inflationary fires. That plus household formation, where you have a bunch of young people coming into the workforce with savings, not debt indentured, so that they can actually start consuming. And that's what we had in the 1960s and 70s with the baby boomers, which was the last big inflationary boom. Yes, we had the war in Vietnam, spending in the US, which was partly behind, but it was on top of the demographic theme of the boomers leaving their families' homes in masses. Not heavily indebted at all. Consumer debt was much less, and interest rates were much higher at that point. So there was a lot of incentive to try and get money into savings deposits, rather than into than borrowing. Right, the incentives were completely opposite. And then you had this sort of big push. Right now, we have the opposite. We have all these young people are not able to form households. The birth rate is at all-time lows. The debt levels are at all-time highs. The housing market has become completely unaffordable for average people. And so the amount of consumption that has been forfeited for the next period of years, because people have already spent more than they should have just trying to get an education or, buy cars or succumb to all this consumption marketing and get into housing, which is going to take them decades and decades to pay for. Now we've just pulled that consumption forward and spent it. So that means we're heading into a disappointing period. And again, the central banks have also helped goose this. Inflation expectations are at all-time highs. And if you look at secular charts of this stuff, secular means, let's say, decades and longer, not a period of 2 or 3 years, but long periods of time. Whenever you get inflation expectations at these record spikes, it tends to disappoint, and they mean revert after that. So commodity prices have spiked. There has been some bottlenecks with the shutdown and the pandemic for sure, but there's also been just this whole obsession with, oh my goodness, we're going to have runaway consumption and financial speculation. Back to my favorite topic of how these firms have been stockpiling, the JP Morgans, the Goldman Sachs, the same old culprits who were doing it in 2008 when they pushed commodity prices to all-time highs as well, have been doing it again lately. So a lot of financial speculation, driving asset prices, driving commodity prices, driving inflation expectations. When everybody's in agreement, right, something else always happens. And I think that we're going to see more likely a deflationary or disinflationary period starting in the second half of this year, where everyone's sort of like, oh, and then we're like, also, just historically speaking, it typically takes about 4 years, 3.75 to be specific on the average, for inflation to bottom out after a recession. If the recession of 2020 ended in April 2020, we likely will see yields mean revert again. In other words, inflation will trend lower over time again, and bond yields will bottom sometime later, not yet, perhaps in the next year or 2 or 3, something in that. That would be normal.
Okay, so I got 2 final questions for you then. And so you're basically in agreement with what Jeff Booth said last week on the whole deflationary outlook for the future. First question. So should I be putting all my money in Dogecoin or Bitcoin? Which actually you don't have to answer that question. We'll skip over that. Final question. So practical advice. I already asked you once and you said, okay, I would not be rushing into the mania of real estate right now, unless I had a specific reason to do so. If I've got a spouse and 3 kids and a dog and a cat, and I want to live in this area for the next 20 years, and I want my kids in that school district and everything, then fine, it would make sense. But if you're doing it as a speculative investment, probably not the right thing to do. So given what you've said about what you think the future is going to look like, what is your general big picture advice for people watching, perhaps for people who maybe have debt and for maybe people who don't? What's your practical advice for people watching?
So you can't get savings until you get out of debt. So that's the first thing. So focus on, yes, have some emergency savings, which I'm sure you always talk to people about as well. But the biggest risk is the levered risk, because life is full of unknowns and surprises. So when you have leverage, when you have debt, you've already made yourself more susceptible, more vulnerable to life's surprises. So getting out of the hole is the first thing. And that means, trying to maintain your personal discipline around finances. Obviously, you need some income. You got to figure out a way. I think people underestimate how valuable different pots of income are. Even things like just, small pensions they may have from some past employment or Canada pension plan. People underestimate what a huge part of one's retirement plan that can be. And they think, oh, well, I'm not going to contribute to that. A lot of self-employed people make that mistake and that sort of thing. Anyway, so getting out of debt and then building up savings and not getting stuck into the mania of, like it's a hot potato that you've got to toss into whatever someone tells you to toss it at because, you're desperate to make it grow. Compound interest over time comes from doing the diligent, constant, low risk, reinvesting of income as it comes in over your lifetime. That's really where strength and stability comes from. So, and realizing that all this, all these clicks and baits and algorithms are all designed to snag at your psychology, to sucker you in. And sometimes I've heard this from many people, even people who retire with good resources, lots of savings and all that. They start trying to do the stock picking thing because they're bombarded daily with, well, if you're brave, if you're smart, if you're wise, if if you're a good provider, you're going to try and double or nothing. I mean, that kind of thing. And then what they do is they ultimately, sometimes it's quite common that it's a slippery slope to psychological torment, because whether it's gone up that day or down that day, whether they've lost or not, and they miss out on the things they're supposed to be focusing on about health and well-being and their life and their family. So, it can be very dangerous. So it's not that you shouldn't take a flyer if you want to, I say, if you want to gamble with some of your money, but I think people are better when they gamble typically, unless they're addicted to gambling, but they're often better with saying, I'm going to carve out $500 or $5,000. And that's my gambling fund. And if it goes, I'm not going to put more in, and I'm not going to be considered wise. If I win, I'm going to be considered lucky. Right. So it's a totally different mindset. And that's why I think the financial sector, with all of its bombarding us, is particularly dangerous to our psychological well-being and our financial well-being.
Excellent. Well, that is a great way to end it. How can people monitor what you're doing? You are on Twitter. You do have your blog where you trash the ads that we talked about. And a bunch of other stuff. And your blog is very succinct, I would say. You post something, I don't know, it's pretty much every day, I think, but it's usually something, very brief. It takes, a minute to absorb it. So Twitter, you are Danielle Park, I believe, right? And I'm not going to ask you what the K is because it's none of my business. And the second question, so your website is Juggling Dynamite, is that correct?
Yeah, well, the jugglingdynamite.com is the blog. venablepark.com is our firm. And people correspond with me through both of them often. And I often will answer people that are not in any way going to be a client of the firm, just to try and give them some helpful direction in the right area. So I deal with readers mail me all the time. So it's certainly something that if someone wants to drop me a note, I will always answer.
Excellent. And I will put links to everything you just mentioned, those two sites, in the show notes on YouTube, so that people can keep an eye on what you're doing. And your book, Juggling Dynamite, which came out, was it 2007? I'm trying to remember. So a few years ago, but it's still on Amazon. People can still get it there. I'll put a link to that as well. And then when you come out with book number 2, because I'm pretty sure when you were on the show in 2019, I actually gave you the title for the second book. I can't remember what it was, but it was brilliant. So when that book is written, you come back on and we'll talk about that as well. Danielle, thanks very much for being here today.
Thanks, Doug.
Thank you very much. That is our show for today. As I said, I'll put full show notes on YouTube to everything we talked about. Thanks for listening and watching. And for those of you watching on YouTube, thanks for hitting the like and subscribe button. Until next week, I'm Doug Hoyes. That was Debt Free in 30.